In 2020 and 2021, hundreds of private companies went public through special purpose acquisition companies. And in 2022, when the bubble finally popped, we were able to see these companies for what they actually were. Because for every SoFi, there was a Clover Health, and for every DraftKings, there was a Virgin Galactic. And Grindr went public during these circumstances near the end of 2022 in November. But what sets them apart is that Grindr was a standalone business that had existed since 2009. A business that not only just made money but was functional and actually worked, which, believe it or not, was pretty unique at the time. But to truly understand this business, you have to understand the the business of dating. I know that everybody that watches my channel at a minimum is like a Mensa level candidate, but in case you didn't know how babies are made, there's a thing in our brains that kind of tell us, hey, time to crack. And that's how babies are made. Trump's wife is cheating on him with a guide, and sometimes dudes crack other dudes. More on that in a bit. You can decisively split a pre and post internet era when it comes to how people used to meet each other. Couple that with the fact that there is just a large disappearance of third places in society and real wages are just going down, 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 down. More than ever, people are ready to jump at the chance at streamlining their soulmate through a series of filters, eye tests, and horrendous opening shots. Not me though. Not me though. I'm first choice, not because I couldn't. Match Group and Bumble have been competing for years in this market, trying to squeeze every little drop of profit that they can from lonely men and women. And the story of these two companies is interesting, but the third player in this game I think is a little bit more interesting. And now while it's true Grindr does have to compete with these guys to an extent, it's kind of like saying Costco has to compete with 7-Eleven. Technically that's true, but they fundamentally serve different purposes in the industry. Now, if we look at just pure demographics, gay people actually tend to be more well off than straight people. And there's a bunch of reasons for that we could definitely get into if you want to message me. And so it feels like apples and oranges when you really try and compare them. But I need a baseline, so here they are. Obviously, the main moneymaker for these companies is essentially the casino mechanics that they add into their apps. Except their rewards aren't cash, they range from catfishes to finding someone that maybe likes you a little bit too much. 95% of the revenue from Match and Bumble comes from their subscription services and consumables like premium, gold, whatever the hell they call it, and consumables like super likes and, you know, the thing that advertises you on the front page. But where Grindr differs from these is that they're able to take advantage of the fact that their customers are not only richer, but also spend more time on their apps, almost twice as much actually. And so while Match and Bumble find it difficult to monetize the freemium freeloaders, Grindr is able to take advantage of them and turn them into a significant source of revenue through their ads business. And so their algorithms are not only going to take into account, oh, you like to hike? Let me pair you with somebody that likes to hike. Oh shit. It's going to start analyzing faces and assigning vibes to profiles. And so it's actually going to start shuttling you towards people that you like rather than people that on paper you should like or people that you say you like. We've all had that feeling when we're, for example, digital shopping. You add all these filters on what you need and then you hit apply and it says no results found. And so then you're like, okay, what if I just drop one or two things? In other words, this is called settling. And while Grindr already had this kind of future, it's being enhanced with AI because now it won't only just listen and have a conversation with you with what you're looking for. It's going to actually give you better results being able to act in real time with that information. This is also why Grindr is so effective at keeping people on their platform more minutes than the other two platforms because they're able to enhance their product to a point that people are actually enjoying being on there, not just logging in for their daily session. Earnings might look like a stoplight, but the growth is green, only being outpaced by their operating margins and EBITDA growth. Operating growth is essentially showing that it's costing them less to capture the increase in revenue, making their profit margins currently at 20%. From a pure financial view, the debt did spike in Q4 2025, and there's a couple of reasons for that, such as debt refinancing, increased capital expenditure on the algorithm as well as infrastructure for the company, and a share buyback program. So they did borrow $400 million to do all these things, but they have a credit line of $600 million, which still allows them a lot of leeway in case they're in a pinch pinch or in case they want to drum up marketing, go into new territory, or launch new products. And say, no, numbers, numbers, numbers. The business works, is what I'm trying to say. The business works. It does it better than its competitors. It's not even really competing with its competitors. It's still 30% from its highs. So what exactly happened? By the way, I know the all-time high is like $70 or whatever. That I'm not talking about that because that was with the SPAC and it's a whole thing. Just message me about it. Surprisingly, it's not Trump or AI that caused the sell-off from 25 to where we are at now. What it really is, yeah, that's right, greed. Surprising, I know. So when they originally announced the share buyback program, you know, the thing I mentioned just now, the original announcement was also coupled with the announcement that, okay, hold on, let me just reenact this. Hey guys, we're going to be buying back a bunch of our stock. Oh my god, that's great for me, the shareholder. By the way, we're also going to print a bunch of stock and give it to our executives. Wait, are you going to strap the company with hundreds of millions of dollars of debt and then turning around and paying yourselves bonuses? No, 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 no. We're simply rewarding our team with bonuses to reflect their continued contributions to the company's growth and success. Shit. Bottom line, we're looking at a company that's top line is growing with heavy user growth and retention, engagement, generating consistent and regular income through subscriptions, ads, and consumables, which are meaningfully getting improved with the implementation of AI, with 20% growth even after launching almost 20 years ago. And if you, for whatever reason, hate what this business does, how could you not fall in love with it? I own shares. I bought back in April, early May, and I continue to buy to this day. Just a heads up on that. I think this has a lot of room to run. It's run a lot lately, so I would probably recommend after the midterms if you were going to purchase. You might find a better entry point there, but that's just optimistic. I think this is the angle that some people need to take. If you have any questions, leave them in the comments or message me on Discord. Right, bye.